Jason, it's nice to see you. It's nice to see you're alive, surviving
Exactly.
Miami in a full corduroy onesie, nonetheless.
Shout out to Tai Tai for that one.
Yeah. Speaking of Tai Tai, before we even say what the name of the show is, before we go into disclosures and disclaimers, I need to read some text from the group chat. I need people to understand what life in this group chat is like. Though I'm upset. I'm struggling to find it. Okay, hold on. Here we go. Did I delete them? Ah, yes. Tyler asks, Jason, can we find the supplier of Outliner's ultrafine merino cut shirts? To which Jason replies, yes, I've sourced Mackenzie Merino before directly. Also, I know the family that has the second largest sheep farm in Australia that specializes in a higher quality. Ladies and gentlemen, the man who would boast such things in our chat group is the man sitting next to me, Jason Buck, the one and only, the young Hemingway. I'm his lowly co-host who knows nothing about the finer things of merino wool. My name is Corey Hoffstein. This is the Pirates of Finance, and those are the sorts of gems you can expect here, I think. Maybe we'll get into that story. Again, you continue to be the most interesting man I know, but before I do have to say a couple of disclaimers, which is we're just a bunch of random guys on the internet chopping it up. We're talking markets, we're talking finance, we're talking unlikely to talk macroeconomics unless we're dragging it. But we're certainly not giving financial advice. So make sure you talk to your financial advisor if you're thinking about making any investment decisions. Not tax advice. Talk to your tax advisor. Really just not advice at all. Just a bunch of guys chopping it up. With that, Jason, anything to say for yourself?
Dude, the booty crew has me crying laughing already. Like just the responses to some of your stuff. And by the way, Brian said the private text group chat, how long does it take a body to decompose? You remember the last week when you read all those texts?
Yes.
Oh my god. Oh man, I'm just getting ripped too. I'm 3 brim inches away shy of having an urban sombrero. I mean, this stuff is just so good.
Yeah, so for those of you who are listening and not watching, because I do know we have a listening audience who likes to catch this on audio, Jason is not wearing the Pirates of Finance uniform today. I am solo in my skull and crossbone sweater. Jason is wearing a corduroy onesie with a Paddington Bear hat, which is probably his most prized possession. I'm surprised he's able to travel with it, given the size of the bags he travels with. But Jason's just going to be distracted by the chat from now on, I guess.
No, my internet froze up too in this hotel room. It, by the way, reminded me of I'm going to name drop. Sorry, I went to dinner the other night with David Senra from Founders Podcast, and I don't want to blow up his spot with everything we talked about. But one of the ones he suggested was maybe not going live. And I was like, I don't know if we can do that to the booty crew. This is just too good. Like the comments in our booty crew chat are just too unbelievable. And other things I told you in our, by the way, I thought our private chats were private, but apparently not. You're going to read them on the show.
Not when you're going to say ridiculous shit like that.
But the other part of it was I was texting you earlier that one of my managers, the first time I saw him in Miami a few days ago, he goes, if you'll notice, I haven't gotten a haircut for this conference. and he was up last year. So it was a perfect it was a perfect Pirates reference. I loved it. And then, like you said, these conferences are crazy. So for people who haven't been to these finance conferences, this is alt hedge fund week. They think most people call it out in Miami. You have MFA, you had Context a few days before, you had iConnections all around like Fontainebleau, Lowe's Hotel, that sort of thing. And I was just telling Corey before we got on, we're at like pre-pandemic levels. I mean, it is just absolute chaos here. Like, I mean, just so many people, so many meetings. And so you basically, I leave my hotel room by like 9 a.m. and I'm lucky if I get back at 1 a.m. I mean, and you're just meetings upon meetings upon meetings, coffee, lunch, dinner, cocktail hour, snacks, drinks, dinner, post dinner. I mean, it is just endless.
And we just been going for days conference straight. And all the networking.
Yeah, exactly. And it's just like, I was thinking I need to hire like an event planner or schedule coordinator, because just trying to keep up with the text and who to meet where at what time is like nearly impossible at these things. I mean, it's just absolute chaos.
I mean, I'm coming down next week for the Exchange ETF event, and the number of coffee and like cocktail / beer placeholders I have on my calendar for meetings with people. I'm like, I'm having like beers back to back. It goes coffee, 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 beer, 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 beer,
Exactly.
beer. I'm like, I don't actually want any of that. Like, maybe I can get a water or an iced tea in there.
Well, one of my hacks is, we both love our cold brews, but when I'm at these, I go espresso, because you're going to get less caffeine and you can do more espressos throughout the day than you can cold brews.
I like that.
Just a little hack for you. Man, I'm getting dragged for this hat, by the way. Just dragged for this hat. I'm wearing.
Wear it with pride. Wear it with pride. All right, I'm gonna take a hard left turn. I'm actually gonna talk about markets, which is pretty unusual for us on this podcast, Jason. But I would actually be
Is that legal?
I know. I don't know if we're allowed to. I'd be interested if you heard anything about this during the week, particularly yesterday. I don't know how much people were paying attention to markets yesterday, but there was an absolute crescendo of dispersion that occurred within markets, particularly between high beta junk stocks and higher quality, momentum winners over the last year. So it's been something that's been building all January, but yesterday it was particularly pronounced to the point that a lot of people are looking for bodies. What long short hedge fund blew up? And so just a couple things I'll point out. Not that I want to drag Kathy Wood as being like, the Paul, like the standard bearer for buying junk stocks, but I believe ARK is up 42% year to date as of yesterday.
Are you serious? I haven't even looked at it. And did I see like a headline quote? Is it true? Like she compared them to NASDAQ or something like that, or what?
I don't know. I didn't see that. I didn't see that. But I only point out, like, I'm going to lump her basket as call it non-profitable tech. So you've got non-profitable tech up 42%. Goldman's liquid most short basket as of yesterday was up 36% on the year. You have retail as a percent of volume estimated by JP Morgan at levels that are higher than the meme stock mania, all at the same time as call option volume hit all-time high. I believe just general option volume hit all-time high, which maybe was a point of discussion at the conference, particularly among the vol managers. But you've had this crazy dispersion in January with in particular, the momentum factor and the anti-beta factor. So one of the things we saw going into the end of last year was you had basically a huge correlation between a bunch of the equity factors. So value, momentum, quality, and anti-beta all started behaving very, very similarly. So huge amount of potential overlap in their performance, potential overlap in their holdings, or whatever their driving risk factors were. Whatever it was, all those baskets started behaving very similarly. And come Jan 1, you started to see a massive sell-off in momentum as a factor and a massive sell-off in anti-beta. And if you decompose those factors, which are normally looked at as long shorts, if you looked at both the long leg and the short leg of momentum and anti-beta, they traded almost perfectly correlated throughout the month. And so to me, as I watched this, it looked like some sort of crowded trade unwinding. Now, there hasn't been a body that has sort of come to the surface, but a lot of people noticed yesterday, like you had the NASDAQ up, I think it was 3.6%, while the Dow Jones was down. Not that I want to say it's like the millennial, Z versus boomer dispersion within the market, but normally that's sort of like tech, junkier tech versus profitable blue chip dispersion metric. That's a really easy one to look at. And something weird has happened in January. I've got a couple hypotheses, but before I go into those, I'm curious if this was anything that was mentioned at the conference. Like, it's just been a very weird month in the undercurrents of markets.
You and I have multiple things coming up together next week and everything. And I was like, oh, this week, at the conference, I'll get a bunch of material. We'll talk about everything going on in the markets. But as you know, all it's been about is like business and nothing actually to do with markets. And so I haven't even seen anything markets. I even saw, I'm glad you just jumped right into it, because I haven't even been able to read your email that you sent out to like your list this morning that it's even talking about this. I mean, I heard in passing little things like, like basically an epic short squeeze on markets and they're ripping higher. But as you've been talking about for a while, is like the risk is to the upside, so to speak. And then maybe do you get into your letter where do you think this is there's buried bodies and somebody's unwinding, or you just think this is just a natural progression of the market?
It's hard for me to say. So I think there's sort of two things going on here. You had January being a really good month for the S&P, up like 6.3%. So macro level, directionally a very positive month, which has, price precedes sentiment. You got people sort of bullish again. All of a sudden, maybe we can pull off a soft landing. Maybe we can look past inflation. We've got it under control. I don't really want to get into that. I think our audience probably knows how we feel about macro prognostications. But within the market movement, which I do think there are some technical drivers of that I can get into, right? It's this cross current that's really interesting, right? The market's up, but you've got certain cohorts of stocks that are dramatically underperforming and certain cohorts of stocks that are dramatically outperforming. Again, to a degree that was really last seen during meme stock mania. And one of the questions that I always ask in like these periods of time, particularly after you have a couple large news events that seem like there's a lot of movement afterwards, is I always like to ask, like, who's actually trading? Like, really take a step back and say, like, who is the they, that mysterious they that's moving markets?
Exactly.
Is it sovereign wealth funds? Is it pensions? Are they trading? Is it university endowments? Is it your random advisor? Is it individuals in their 401ks? As far as I can tell, and this is like, could be wrong. As far as I can tell, most of the day-to-day is a bunch of day traders, market makers, and people having to deal with putting on hedges or taking off hedges. And that the true fundamental flow that occurs is slow and incremental over time. And so any large reactions to news, to me, tends to just be from hedges unwinding or being put on, right? Surprise repricing that's occurring because of hedges that were put on before. But it's not, to me, like, oh, a sovereign wealth fund decided to jump in here most of the time. That's not really how it works. So when I look at what played out over January between these baskets of stocks, do I think it's a fundamental repricing? It would be fast for a fundamental repricing to me. I look at it as there was maybe a couple of narratives. One that I could see as being possible is when you have a high degree of correlation across equity factors, long short hedge funds will, if they want to maintain the same risk profile, as that correlation goes up, they need to decrease the amount of leverage they have just to keep the same vol target. So they have to sell the stuff that they bought and buy back their shorts, right? And if they're in a crowded position, that could cause all of a sudden other hedge funds to have to do the same thing. And you get this sort of crowded squeeze, particularly in the shorts. You tie that in with some retail trading that pours a little gasoline on the flames. And that might have been the cause. You might have had retail lead the way. Retail starts buying, for example, a lot of the short names. That causes a lot of these hedge funds to start covering, and you get a short squeeze, and they have to sell down their longs at the same time. So, I don't know what was leading or lagging. The other possible answer is hedge funds came into the year with very little beta on the books, very little net exposure, right? So when you think of a hedge fund being 100% long and 100% short, their gross exposure is 200%, but their net exposure is 0. If they want to add some net market exposure, they can do one of two things. They can buy some more longs, right? Maybe they go 150% long, 100% short. Well, now their gross is 250, so they're eating up some of their risk budget, even though their net's 50. Or they could just buy back some of their shorts, so they could stay 100% long, 50% short. Now they've actually increased their net and decreased their gross, right? Which might be good from a risk budget perspective. So if you buy the thesis that hedge funds actually fundamentally wanted to get longer the market after last year. They had this fear of missing out. Things are looking rosier after Q4. Again, all very debatable whether that's economically true. But one thesis is they all wanted to get longer. The best way to do so was to start buying back their shorts, which was a crowded position, which created a short squeeze. And again, you get these shorts that are running massively. My long view here, and then I'll stop my ranting and rambling, is that like levered unwinds and technical flow. Yes, I'm begging the question. Thank you. Thank you, Tyler. Little that thing kills me. Levered unwinds and technical flow that's not truly tied to like a fundamental thesis tends to revert, and it tends to revert pretty quickly. And so if I were, think like, I guess I just like, I'm careful to read too much into any of this movement in any direction when it seems like a lot of the movement might just be hedge funds basically having their hands forced.
What I love about all that in a tangential way is like when I was on a panel the other day, one of the questions was, talking about volatility, how do we think like zero DTE options and all these other factors are affecting volatility, and do they affect the volatility, and how volatility changes through time in the vol surface? And my answer was yes and yes. And it basically, you went through like a 10-minute rant, which I love, by the way. But to essentially say what we always basically say on the show, and I'll shorten it, is like it's integrated, like complex systems integrating with complex systems, integrating with complex systems, right? And it's a little bit of A, column B, column C. I'm not like, I loved your rant, but like part of it too
in
is,
my defense, I tried to make myself sound really smart while doing it.
No, it was. That's what I'm saying. But like, and then I'm just the asshole that tries to make it concise. That's like, yeah, it's complex systems interacting with complex systems. It's impossible to figure out exactly all of the narratives, except for even in hindsight, that narrative is usually false anyway. But part of it, what I like what you're talking about is, you sent me a link to a tweet that I didn't even have time to read the tweet thread the other day. That's how like packed everything's been. Like I get maybe a few minutes to myself, hopefully in an Uber sometimes. But it was talking about kind of quant quakes and leverage. And so even when you're just talking about long short positioning, do you think those are just different form factors to what Minsky used to talk about with like Minsky moments? As credit builds up, as volatility comes down, people take more and more leverage, or they adjust their positioning on a long short. And that can lead to these, to quote, liquidity cascades, or any sort of like short squeeze to the upside. Those sorts of pops that you're going to see is because people, like you said, are adjusting positioning. They're positioned on one side of the market, and leverage starts to build up, and then it snaps, and then we see a little bit of unwinding.
Yeah, I think that's exactly sort of the thesis here, right? That you got people who are crowded into a number of well-known factors. And as vol has been dying down, they're able to increase their gross exposure. And then as vol picks up, they're all sort of forced out. But when everyone rushes for the exit at the same time, it forces volatility to pick up that much faster, and they all have to rush to the exit that much faster. And it creates that pro-cyclical spiral. Now, what happened yesterday was nothing like the August 2007 Quant Quake, which was magnitudes worse, right? So I think the person calling yesterday a Quant Quake, yesterday what I don't even think was on the order of what happened when the original vaccine trials were announced in November 2020. Like,
right.
It just wasn't even close to the same level of dispersion. But month over month, actually, I think momentum as a factor in January had its worst month as a factor, as a long short factor, in at least a decade, I believe. Right. So it was bad as a month. Like it was, a historical outlier. It was pretty ugly for anyone placing that trade. But to your point about the Minsky moment, I think one of the things I've always talking about complex systems adapting, one of the things I've thought about and never really gotten very far with the thought is, as all these anomalies are published and become factors and get adopted into the way people build portfolios, it almost reinforces crowding, right? So MSCI BARA optimization that's going to take into account all of these factors. Well, if everyone's using the same factor definitions and optimizing to the same factors, they're all going to get crowded in the same stocks, which is going to cause these events to happen more. or if they all try to neutralize for these factors, they're all avoiding the same stocks, right? So you end up with this interesting dynamic of the more well-known and adopted and published these risk factors are, the more it sort of forces us to treat them as consistent baskets, right? Which reinforces the correlation among them and can lead to these weird crowding effects. So I think there's something to be aware of in markets. If I could put a grand sweeping point on all this, it's the point I try to reinforce to like my father whenever markets do something weird. It probably had nothing to do with anything you saw in the news. Probably had nothing to do with, you know, any earnings or anything like that. It was probably just some hedge fund somewhere blew up and had to unwind a position.
And we'll find out exactly what it is a few months from now, and then we'll dig through all the debris
or
6
maybe
to 12
never,
months from now, and never. And then we'll find out what really happened. Absolutely never.
It was some pod in Millennium, you know?
Yeah. So to talk about actually the Minsky moment, actually, it's the Minsky quote that I love the most is stability breeds instability. So when these people are doing their look backs and everything, and they see volatility coming down, they see a trend line going up and to the right, that's when they start piling into more and more leverage, because that stability, you know, it gives people the confidence to pile in, and then that's if it eventually breeds the instability, and then it's the sand pile effect, and you just never know what's going to be the camel that breaks the straws back. And so that's the interesting piece to that. By the way, some of the people are asking in the comments, what are the time frames that the time price base factor indexes are based on?
Wait, can I just rewind?
No, I did that on purpose.
Okay,
I did that.
I just wanted to make sure. I just wanted to make sure.
That.
I hope other people thought that. I was like, you don't normally misspeak.
No, I did that on purpose, just like for those sorts of reasons. Yeah, because it's funny to me.
What time?
I always like to say, by the way, I like to say cross your I's and dot your T's too.
That's good. See who's really paying attention.
Yeah.
So the question from the audience here, what are the time frames that these time/price-based factor indexes are based on? So they all vary. The factor indices that I'm talking about are less time and price based, right? Except for maybe momentum. And a lot of times when you're just studying this stuff academically, it's like a 12-month winners versus 12-month losers. You know, anti-beta, you might be talking about high beta measured over the last 12 months versus low beta over the last 12 months. Like, and you can define these things a million ways, and you probably should and run an ensemble when you're looking at this stuff. But again, going back to the risk factors that matter are the ones that the majority of people are using. And so you can also look at like things like the BARA, MSCI BARA definitions. But that does bring up another sort of related point, though, which is another really interesting potential source of flow in January that could have been supportive of markets as at least a marginal buyer is we saw vol in equities come way down, and we saw vol in bonds come way down. And we also saw trends in equities have gone from negative to less negative to slightly positive, depending on whether you're looking at shorter or longer time horizons. And so that affects three categories of buyers: managed futures, risk parity, and vol targeting funds. So one of the things I think people get wrong with managed futures is they think for managed futures to buy, trends have to be positive. That's not true. Trends just have to be less negative, right? So if you had super negative trends, it means that the CTAs are really short. As trends become less strong, less negative, they need to buy back their shorts, right? Similarly, when trends are really, really strong, they get maxed out in their position, and then trends can still be positive, but if they get weaker, they'll actually become a selling pressure. So in January, CTAs looks like they bought about 100 billion in global equities. Now, I will say that's skewed more towards the global side. Trends there have been stronger than on the US domestic side, but 100 billion of buying pressure, it looks like, throughout January. And then you had risk parity with both bonds and stocks. I'm not going to talk about the commodity side, but yes, commodities are part of risk parity. I don't want any of the reply guys saying I think it's stocks and bonds. But with bond vol coming down and stock vol coming down, it gives risk parity the opportunity to relever and target vol indices. If you just look at sort of trailing 63-day realized vol in equities, it's come way down. And so that has been supportive to those strategies relevering. And so it looks like there's been 100 to 200 billion across CTAs, risk parity, and target vol of marginal buying pressure that could quickly turn into marginal selling pressure if vol picks up or markets turn around. And I think it's always important to consider those factors. Now, there's a lot more that could be bought, particularly among target vol and risk parity. Like they could relever to a significant degree and continue to be significant buyers if vol continues to decline and stay low. But, you know, again, it doesn't take much for these things to flip around and they become, you know, 100 billion sellers in the next month. And that's something we saw, I want to say it was last June, July, August. That's exactly sort of the same pattern we saw.
Several things. That one, shout out to Noel from Convex Asset Management that's in the comments and watching today. And he put in the comments, large VIX call trades yesterday spooked the market. So Noel's one of those flow traders in the option space. So go ahead and follow Noel and you can get, you know, information about how do you track flows within, you know, different market makers and looking at different forms of liquidity and flows within the option space. Noel's a great follow for that. And any of his interviews are phenomenal. There's so many things you said in there. One, by the way, I want to go back though to it wasn't a quant quake. So you're good at naming conventions. We got to come up with a good phrase. So do we want to call them like rotation quakes?
Well, I don't even want to call it a quake.
Going back to November 2020.
This was like a little tremble. This was like a murmur. I don't know, like
pinprick, but you remember like the November 2020, that was pretty violent for people that
was very violent. But like on the Richter scale of quant quakes,
yeah,
you had, you know, I think let me see if I get my numbers right. August 2007, you had down like 20 to 30% in 1 or 2 days among multi-factor quants. November 2020 was really just value ramping and momentum falling apart. So if you were in multi-factor, was not a painful day. If you were super overweight momentum, yeah, I think it was the momentum factor was down 7% in a day. That sucks, right? But multi-factor didn't really get crushed. And again, yesterday you had this big dispersion that probably hurt multi-factor because it was on the wrong legs of all this, but it was like, I don't know, to the tune of a couple of percent. It's really like what was more cumulative. It was the cumulative pain throughout all of January. But yesterday this was not nobody was blowing up. Well, let me put it this way. The industry was not blowing up yesterday. So on the Richter scale, it was minor.
Do you want to go, like rotation tremors or something like that? By the way, shout out to Jim Carroll. He put shimmy shake in there. I like a good shimmy shake. By the way, did I text you guys too? I did manage to squeeze in a pandy wandy on my panel the other day.
Good for you. You didn't text me, but I'm glad you did. I feel like I've got some panels coming up next week that you got to give me.
I hope all my sake some of them get in there. You're gonna say something on there. You'd be like, I cannot believe I just
know who
said
used
that.
to do this? Meb Faber, before he'd go on CNBC or Bloomberg, would go to Twitter and say, "Give me the most ridiculous phrase to say," and he'd try to squeeze it in, and he was pretty good at doing it.
He said he also gets it from his son, but before I ever heard that, I used to do that when some of my first interviews on Real Vision. I'd ask my girlfriend for vocab words, and I was like, I'm gonna squeeze this one in there too, just for shits and giggles. But there's other things you said. Sorry, I interrupted your train of thought, but you were talking about EM, emerging market stocks, everything. Yeah, after having a hell of a headwind in last year with the rise of the US dollar, EM just came raging back this month, which was fascinating to kind of watch. And so you had not only just US stocks obviously did well, but if you really look at foreign and emerging, they did much better. And then
can I ask a quick question there?
Right,
not to cut you off, but we do this all the time as an industry, and I'm equally guilty of this. We say foreign had a great run this month. EM had a great run this month. When in reality, it's well, actually, locally priced, they did just as well as the S&P, and then the dollar sucked.
Yeah, exactly.
We do that. I guess from our perspective, that implies that they did well, but it wasn't in local dollars they did phenomenally well. So why do we do that? Why don't we talk about the currency?
No, that's great because there's a couple ways I think about that though. I talk to a lot of EM stock pickers, everything, and I always ask them do you hedge your dollar exposure? So that way you can just show that you're providing some sort of pure alpha. And I'm using alpha in quotes because you know how I feel about alpha. I've had many arguments about alpha this week. It's been great. But then my second question though for you, throwing it back to you, is historically, that has been the negative correlation. But is that like definitive into the future? And so that's what concerns me is if you hedge your US dollar risk and everything, historically, that's what you've been supposed to do. And then, like you said, that's a no arbitrage condition. Like you're saying, in local terms, they did well, but that's a no arbitrage condition. But like in future, if you thought that had, especially on emerging versus the dollar, if you thought they're negatively correlated, what if you get smoked and they start becoming correlated over time?
So I believe it was Fisher Black who wrote some of the original research on this, and his take was 50-50. Halvesies, Jason. Halvesies
Halvesies.
came up again. And you know what? When Fisher Black says halvesies, you know that makes me happy because that man is way smarter than I'll ever be. I believe he said, yeah, you should, of your foreign investments, 50% should be dollar hedge, 50% should it. Here is what's always been, I don't want to say always, this is something actually the late great non-related sense really illuminated for me was when I'm hedging a company that's foreign, like what am I really hedging here, right? So let's say the company's listed in London, and so I'm going to do a dollar pound hedge. But what if the company makes all of its revenue in yen? Like what if it's a Canadian company that makes all of its money in euros? Like isn't the source of their revenue, like the earnings for them is what's important, right? So why would I hedge the Canadian dollar if they're earning euros? Like what really matters is the true flow of where the currency is coming from. So if you really get into the hedging literature, like if you're buying a diversified basket of foreign stocks that has a diversified source of earnings revenue, like you have to consider, are they internally hedging that revenue? What are they hedging it to? Do you want it? I mean, like, by the way, we don't hedge foreign currency for Coca-Cola, who has tons of foreign earnings, or any of our blue chip companies, right? So it's like a very confusing thing to really think about. I believe as far as I got with the literature was like you really want to hedge those companies that are I guess it's like earning and spending domestically, like all of their revenue is domestic and all of their expenditure is domestic. But it gets a lot more complicated when the earnings or expenditures start happening abroad in different currencies. And you need to understand how they're internally currency hedging to make sure you're not undoing things. Long story short, you can't just say a company's listed in a certain country and therefore you want to hedge that currency.
Yeah, like our buddy Meb likes to put out all these surveys to see, you know, how many people are just, you know, home country bias weighted, right? But then Meb will deal in the nuances of like, okay, say your home country bias, say you're U.S. national, right? But all of our Fortune 100 or our conglomerates are global conglomerates doing business in 80 to 120 countries, right? And so, do you go through their entire, you know, balance sheet to see where all those inflows are coming from, and then how many of those contracts are then the dollar is the new moarr? And so it's really hard to figure all that out. So yeah, when you say, oh, your heavyweight, you know, U.S. stock indices or U.S. stocks, it's like, well, how many currencies and how many foreign exposures do I have in there? Depending on, you know, what kind, is it an industrial? You know, is that industrial European or Asian heavy? It's impossible to really know that stuff. I mean, and you would have to really, really dig. And as we talk about frequently on here, nobody really does due diligence. But before I get into like the CTA world and some of the stuff you were talking about there, it was making me think about, you know, we talked about complex systems, interacting with complex systems and all that stuff, and trying to figure out, you know, was it a hedge fund that blew up? You know, was a long term, what kind of happened over the last week or so? And you know, I was reigniting this conversation with our mutual homie Rodrigo Gordillo, who we'll all be together again next week. And you know, when everything was going on in Peru, I had texted Rodrigo, you know, because his family's there and everything like that, and asking, you know, is family okay? What's going on? That kind of thing. And of course, you know, he has all this information on the ground from like his brothers, his dads, his cousins, everything. And he's like, no, it's not what they're reporting in the media. And I'm like, well, you know, expected that, you know, but then Rodrigo was kind enough to admit, you know, that he has Gell-Mann amnesia. So he said, you know, everything in the news reporting about Peru is bullshit compared to the information I'm getting from my family on the ground. But then he's like, I do all that. And then an hour later, I'm reading about what's going on in Ukraine. And he's like, this is facts. And so once again, like we just really don't know. We're all guessing. I think you put together a nice thesis that incorporates a lot of different models interacting with each other to see, kind of figure out what's going on.
No, what it does is it confirms all my priors.
Exactly.
Let's be clear. Let's be 100% clear here.
Exactly. So the other one that's kind of come up this week is I've had a couple of dinners and stuff like that with a lot of people in the CTA space. As this is all hedge fund week. There's kind of two main things I was gonna bring up. One is obviously like you brought up earlier, like CTAs are having they had a rough January, most of them. And once again, we can't paint a broad paintbrush. They're not monoliths because the CTAs that are heavy metals, they did a great month, or they were at least positive or flat. Where it really depends on like are you trading the financials? Are you trading FX? Are you trading softs? Are you trading metals? What are you trading, and in what proportion? So it really, you can't. What we always talk about, like hedge funds, just means that an LLC. So we can't broad stroke it. Similar with CTA. So it was interesting to see the ones that were metals heavy did just fine this month, and then the other, and maybe some other sprinkling in there as well. I think isn't OJ up big, but nobody can trade OJ because of capacity constraints. The information I was getting though from other CTAs is kind of, I don't think we could pull up the chart that you drew. I don't know if you hand drew that or you found that somewhere online, where we were on the CTAs. They obviously had a great 2022, and like the phone's not ringing off the hook. They're not getting a lot of inflows, and they're getting the typical like, oh, I must have missed it. Like it's too late now. Whereas like, a couple of years ago it was too early, or, I'm going to wait for a drawdown. And then as soon as you get in a drawdown, no, I can't invest. You're in a big drawdown.
And you had that. Yeah. The inflation's not a risk. We've got it under control.
Exactly. Well, part of that is, I think it was Brent Johnson had like a tweet earlier today. Is like, you see the vociferousness was just as much about like Powell can't raise rates. And so, or the economy will collapse, is the same vociferousness you hear now with like, oh, it's going to be a soft landing. And it's like, people are just always wrong on both sides, but always adamant that they're correct.
Right.
But what was the chart you had? It was something like, you just had like this bell curve. It was just basically like, it's too early, I can't invest. It's too late, I can't invest. It was basically either way, you can't invest.
Yeah, that's basically it. No matter what the situation, you can't invest, and that's spot on. And I think we talked about this last fall, where I said the number one issue I'm facing now is people saying, I think I missed it, and they don't want to be wrong on both sides, right? So you're the 60-40 investor who rode stocks and bonds down all the way last year, and to their credit, not making a change at the end of this year has made them look good because they're getting stocks and bonds up in January. They didn't transition at the wrong time. Any sort of portfolio transition, and people are going to hate this, but it's a market timing call. It's not an intentional market timing call, but if you do something at a point in time, whether you did it that day, a week before, a month later, is inherently introducing a timing element. And the larger the change in your portfolio, the more impactful when you did it becomes. And so I think for people, practically for most institutions and most advisors, it's hard for them to make small incremental changes. People don't like making small incremental changes. They're not patient. And I think operationally for most advisors, it's a complete pain in the ass when they're running a large book of business to make small incremental changes. And so they run the risk of making big reactionary changes to the market and asset classes. And so I think CTAs go, great, we proved exactly our value. And everyone's going, yep, but we missed it. Why buy now? We don't want to sit in cash for the next, we don't want to sit on absolute cash-like returns for the next 5 years until inflation comes back. If ever.
One of the other ones I saw recently was something like, we haven't had like back-to-back outperformance years from CTAs in like decades, so it's just not going to happen in 2023. And I'm just like, what kind of prediction is that? And then the other one, as you know, we're not a global macro pontification show, but it's phenomenal to me. What do you think it is where, if you look at any sort of inflation numbers historically, whether you want to debate what is inflation, what CPI, ignore all that for a second, is that all of these things go in waves historically. So it just doesn't just go up and come back down. It's going to go back up and come back down again. And it's just like waves and but people just seem to miss the wave. Like, why do you think that is?
I got a great marketing email from Campbell, who I don't get a lot of marketing emails from. There are firms that I get. By the way, you want to know how I know liquid alternatives are back? This might mean something to 0.1% of people who are listening. I received a marketing email from Hatteras Funds the other day. You probably don't know who Hatteras Funds is. My inbox was spammed with so many Hatteras Funds marketing emails during the 2013 liquid alternatives boom that it was like when I received my last Hatteras Fund marketing email, and it looked like they were like going under, I was like, the boom is dead. They're back. I just received one the other day. I was like, this is how I know liquid alts are back. But Campbell, who does not send a lot of marketing emails, sent me this one marketing email that was like, this is where you might be. And it showed the 1970s inflation impulses. And it pointed out that it happened in 3 waves. You had this like inflation impulse, then inflation came back down. Then the second wave picked way up and came back down. And then you had the big third wave. And it was like, you might be at like, maybe we have this under control, right? And we're at the, sort of crest or coming down off the first wave, or we could be picking up for a second big wave. And if you don't know, again, how do you allocate without sort of bias into a potential unknown? And that's the big question we're all facing. How do you allocate for the unknown?
Right. And it was interesting, as you won't be surprised, all like the CTAs I was talking to are all talking their own book, that this is another big boom. This is another commodity super cycle. This is a decade run, like inflation and volatility are going to stay high. We're going to crush it for the next decade. It's like, you just don't know, but you could position size accordingly and in your overarching book as a total portfolio.
They can pray.
Yeah.
Hey, so
but it's understandable. People talk their own book.
Yeah,
go ahead.
Well, that's what we have to in the asset management industry, except on this show where we're not allowed to, or really most of the time when we're not allowed to. I got 2 other topics. You mind if I jump topics, or is there anything else you wanted to bring up there?
Yeah, I mind. You can't do it. I'm sorry. You have to be quiet.
I don't want to cut you off. Listen, all I know is one of us has been busy at a conference all week, and the other one had to prepare for this show. So I've got topics lined up.
Your back's hurting from carrying, as always. I get it.
Okay. I think I clued you into this one, but this is something you and I were talking about earlier this week, but I find it endlessly fascinating, and I can't stop thinking about this. You're a little older than me. I suspect you're of the MTV generation, though I also suspect your parents didn't let you watch MTV. Like, you probably had to sit and read like philosophy. Maybe you got 15 minutes of MTV per day.
Oh, God.
But you're the MTV generation. And for me, it was like Carson Daly was on right after I would come home from school, and you'd watch the music videos, and music videos were everything. And, MTV was like a big part of me growing up. And I don't even think I was at like the MTV crest. MTV is a shell of what it once was. And I looked up the MTV schedule for this weekend. Now, there is one show that they are going to play this weekend, and it is Rob. Well, they're going to play multiple shows, but Rob Dyrdek, ex-professional skateboarder. He used to have the show Rob and Big. He had the show his Fantasy Factory. He had the show Ridiculousness, which was basically like, America's favorite home movies, but all about, skateboarding and motocross and funnier stuff like that. His show Ridiculousness dominates the MTV schedule. I want you to guess what % of the time it will be on air this Saturday and Sunday. What if you turn on the show, turn on the TV and watch the entire weekend? What % of those 48 hours do you think will be dedicated to his show Ridiculousness?
Unfortunately, I wish I could pretend that I didn't know the answer, but I do know the answer on this one. But I will say, anecdotally, it's always funny. I'm one of the people that constantly have it on in the background. And every time my girlfriend's like, what are you doing? And like, what I'll do is I'll turn on the TV and I'll go, hey, Ridiculousness is on. And she's like, you're an idiot. And because it's just always on.
So I calculated it. It is always on. I calculated it. This weekend actually seems light compared to past programming. It's only 50% of the time.
Oh, that's light because it's 60% of their programming overall. It's Ridiculousness especially since the pandemic.
50% of the minutes that MTV will air this weekend are Rob's show Ridiculousness. I had completely lost track of Rob. I didn't know what happened to him. Turns out the guy is worth north of $500 million. He has created what is effectively his own venture studio where he's not investing. He is creating and then spinning out businesses. You go back and you look at what he did with Fantasy Factory and the way he structured deals, and you realize that dude was an entrepreneurial genius. Genius. I didn't realize when he partnered with DC Shoes back in the day, he was getting, he created like 100 to 150 of their shoe designs and got a % cut for every pair sold.
Yep.
Fantasy Factory, one of the terms of the deals was that he was able to cross promote any of his other businesses for free. So anytime you were watching Fantasy Factory, he was constantly talking about his other businesses, driving free advertising his own way. Ridiculousness at the end of the run of that show, by the way, I think he made 270 episodes total. In the last 2 seasons, he would only agree to do it if he could do it under his own production company.
Yep.
I mean, he just kept every chance he got. He pulled control from a business perspective, and now just is completely out of the limelight, but is a absolute dominator as an entrepreneur. It is mind-blowing for someone I completely lost track of.
Well, I don't think you're gonna be surprised to know. It excites me that this is you're now discovering this, but I've been tracking Rob the whole way, and it just been a huge fan. Love what he does, but I didn't even know where you're going with the MTV thing. But he did make me reminisce about a lot of MTV stuff. It was Yo MTV Raps would come on at 2:00 in the morning in Michigan, and I would set my alarm to get up and watch Yo MTV Raps, and I would record it, and I would make mixtapes to sell in school. And that's when I was in like middle school. And then like you said like TRL, like remember like after school shows, like we'd come home as like latchkey kids, right? And you would have all these after school programs, but TRL, well, that was breaking new ground, and we all watched like TRL, right when we got out of school. Right. But what I love about Rob, and even this goes back to the MTV generation, is like there's a thesis called like the Browning of America, that like the MTV generation was raised on like hip hop and moguls like Puffy, like Sean Combs, like Jay-Z, and like you see like that really bootstrap hustling entrepreneur, right? And Rob, that's why I love about like skaters or whatever. It's a very DIY ethos. And if you ever watch a professional skater try to perfect a trick, like if you ever seen the Tony Hawk trying to do the 900, these guys are beasts. Like they can take so much pain, and they're just so determined and driven and single-minded focused to get something done. If you have any sort of business brain, to make that work is unbelievable. So there's so many things, like you said, like he negotiated the DC Shoes contract. He was pitching 3 shoes a day to DC, but then over time he like even changed the structure where he would take less upfront pay and more royalties on the back end. And then you're saying like he started pitching all this stuff to MTV, and then they got so desperate, he was the one that could really dictate terms to MTV. And there's so many like little nuances in there that he saw. Allegedly, the story goes, he looked at America's Funniest Home Videos, and he saw the syndication sale when they sold that for like back in the day for like 300 or 500 million on the syndication. He's like, oh shit, I can do like a modern version of this. So it was more about the syndication. What did surprise me, and the thing I think you shared with us, is like, even on the show, just his appearance fee on the show, because he's done so many episodes, was like $110 million in appearance fees, if those stayed consistent through his original contract. And that's not including, like you're saying, the syndication on the back end. And then what he's done with his it's called Rob Dyrdek, the machine, something machine for his business machine, is like he super optimized himself. He's like, I really don't understand balance sheets, P&Ls, business. He got all these coaches to teach him everything. And then his thesis once again was, if I can buy or start businesses for, a few $1 million or a few $100,000, and each of those businesses can be worth, $50 million. I only have to do 20 of those businesses to become a billionaire. And so that it was just like micro PE kind of strategy. Like he just kind of reverses engineers everything. And then he has tattooed on him Relentless, I think was like his first tattoo, and that's all he is. Like he comes out with a basic thesis. He's got so much charisma and energy, and then he just relentlessly pursues that basic thesis until he gets it done.
It was a massive snowball effect. Like, and I know what was wild to me was looking back at his story and being like, a guy who was a skater who really wasn't a great skater, but had this opportunity, and he made some money out of it. And to your point, like, he is relentless. He is a hard worker. Right. But whenever he got a business opportunity, he'd claw a little advantage to his side, taking risk though, right? Saying, I will take less up front and more on the back end because I'm going to make this work. And he did that. And he recognized the value of brand, and he recognized the value of being the person in the spotlight, being able to cast that marketing light on his own projects. He was very early in the skating scene, even though he wasn't the best skateboarder in the world, which annoyed him, and he worked really hard to become really good, right? He was on skate magazines, and he was always featured because he was a funny personality and he was a big personality.
You may not know this too, because we always talk behind the scenes about his fantasy factory and how we both want like a fantasy factory at some point. But I think you pointed out that he talked about his fantasy factory was a break even or slight loss, but it was part of the show and building his company, so it wasn't really a loss. But I don't think what was talked about on the thing you sent was he actually originally he was like a multimillionaire in commercial real estate before that. Even when back in the day when he was a skater in San Diego, he used to take any money he made off skating and DC shoes and plow it into real estate and commercial real estate in San Diego and LA. So he owns like tons of commercial buildings. So he was wealthy off of that before any of his businesses really hit, as far as I know. And it reminds me of Arnold Schwarzenegger was the same. Did you know he was multimillionaire off of commercial real estate before he really even blew up as a bodybuilder?
I think I did know that. Yeah. It sort of reminds me the other viral clip I saw going around.
My internet's dying a little bit. Are we still?
I'm with you. I got you, buddy. Stay with me. We got a couple more minutes. It reminds me, another viral clip that was going around this week was of Chad Ochocinco. I don't know if you saw that one.
Yes.
But to the point of like people who were started making a lot of money and didn't spend it on the flashy things. Now, Rob did do a little bit of flash, but it was like a purposeful reinvestment in his self-brand. Like, I think it was very thoughtful as to what he was doing. Look, maybe we can all retell history. Maybe the dude just wanted to ball out.
He was young. I mean, we make mistakes when we're young.
Right, but Chad Ochocinco, this viral clip that was going around, this interview where he's basically saying he saved 83% of his salary. His view was like, there's nothing I can buy that's worth more than my name. So why spend money on anything? You know, why spend money on a nice watch? I can just ask you what the time is. Time is free, right? And he kept it all. And I think it's always interesting to me to hear about these players in different industries who make it big and are silently investing massively into whatever investments are their favorite investments. And you find out later in life, like the fortune they've amassed from real estate or stocks or private business deals that they've done, lending their brand or their know-how, is always massively impressive. And it's like this whole second career arc that they're given.
There's by the way, in the comments, Brian said there's a whole subset of young people that fixate on real estate investment. I don't know where it comes from. It spans cultures and class. I know exactly where it comes from. It comes back from my childhood. Late infomercials were buying real estate, no money down. It comes from Rich Dad, Poor Dad, and now the modern version of the world, like Grant Cardone's of the world. And they're all everybody.
How about just the American dream? The American dream: buy a house. You know, they are only making so much real estate. Yeah, I mean, it's baked into our culture for sure.
Right, but then, yeah, how long does it last? And I mean, we've talked about, the vicissitudes of commercial real estate in the past, or just everybody becoming a real estate investor. There was but that other one with Chad Ochocinco, I don't know if this is apocryphal or true, or if he's just talking about in hindsight. I think he also said, like, for the first few years, he lived at the Bengals stadium. Like, he would sleep in like the locker room and place it inside the Bengals stadium to save money. But at the same time, I always wonder, like, if you're going to be a professional athlete, it's understandable how, you do want to ball out or floss with whatever jewelry or cars you want. But I'm always like, why wouldn't get like a tiny apartment near the stadium and then actually spend your money on like a chef and a personal trainer, or like a personal, like, soft tissue masseuse or whatever, and really just invest in your career. But like, nobody gets the education on how to properly do that anyway. But I think the LeBrons of the world, and I'm terrible at football, but there's the lineman for Carolina, Chandler, like he talks about it too, like how much he spends in the off season on just his body alone. Yeah, Tom Brady. That's controversial, right? The Tom Brady method.
Yeah. Okay. Yeah. But still, I mean, the point is the same: massive reinvestment. But as a percent of, intake, I'm sure it's actually a very small reinvestment for some of these people. But yeah, I mean, if your instrument is your body, you would think you'd want to reinvest in that from a longevity perspective for sure, and operate. You want to maximize the potential, and sometimes reinvestment is how you maximize the potential. I got third topic for you in the last 5 minutes.
Yep.
You ready for it?
Yep.
Hamilton Lane, $824 billion asset manager, just opened 3 tokenized funds on the Polygon blockchain. Thoughts, Jason?
Do you know how many times I had to reread 824 billion? Not to think it was a ton.
824 billion.
And I showed some people, they're like, wait, does that say 824 billion? I'm like, yeah, it does. So I haven't had time to dig into this. I appreciate you saying it because I'm fascinated by these things. It seemed like they launched a feeder fund for their main funds, and their main funds have a $5 million minimum and are closed, but the feeder fund has a minimum of 20K. How, without digging into it, how does this actually work as a workaround? Because that's what I assume it is, right?
So that's what I tried looking into, and I can't get a good answer.
Exactly.
So they did it with this company called Securitize. And there is as a U.S. resident and a U.S. domiciled person, there is a U.S. version that you can buy. So this, in theory, whether it's been SEC blessed or not, they think it will be SEC blessed. And if you go to Securitized, if you go to their website, you can find the Hamilton Lane Fund, and you basically agree to purchase a certain amount. And I think there is a minimum of 20,000 is the minimum investment. You pay through the blockchain, and then you're given a token that represents that fund. Now, what I don't know, and maybe it's just because I haven't gone through the process, is there are definitely KYC and AML laws, anti-money laundering laws, that have to be adhered to here, right? So I don't know how Securitize is dealing with that. And then it's a question of, how do you ever get your money back? So Securitize has a secondary market, and in theory, if everything is tokenized, you could go to Uniswap and put a pool of Ethereum and this token in. But for the token to track the NAV of the underlying, you need an arbitrage mechanism. And I believe these are private investments that are being made. So there's no way you can do like an easy redeem at NAV. Like, these aren't liquid investments. So I could see the token like having a massive liquidity issue. Like, if there's no one there to buy the token from you, then I'd really want to understand the potential redemption schedule of the token and how similar or dissimilar it is to the redemption schedule of the private fund. Or it may just be, and again, I don't know the full nature of these funds. It may just be, hey, you're going to get paid out in holding the token. If you're the holder of the token, you just get paid out the cash flow over time, right? It's like a one-time, you put your cap call in, and they're doing a PE deal, and you're just going to get an earn out over time until the fund closes. That structure is actually kind of interesting, because then it's like, well, anyone can buy it from you at any time. And it just, if it's in their wallet at the time the distributions happens, they just happen to get the distribution and percent of the total tokens. So there's actually an interesting model there that doesn't require you having the redemption sort of arbitrage mechanism, but fascinating new ground to break.
No, I think you're exactly right. My guess would be the latter, right? That it's basically a lockup, and you're supposed to get your cash flow, your return stream, and there's no liquidity there. The whole point is that there's no secondary liquidity. It's much more just an access point, and then you get whatever distributions end up coming over time. But then second, like going back to the first part, is like, as I'm saying, do you think there's like, with the 99 rule, is they have 98 big investors, and then they do a feeder fund that's the 99th investor, and we've seen historically people use that as a workaround? Is that what you think's going on?
Possibly.
I'm not saying
I honestly have no idea. Like, I tried to look, and look, I will say it's been a very busy week.
Yeah.
You've been gone. I've been alone. I've had to hoist this show on my shoulders all week, doing all the research myself. I don't know. I looked into Securitize briefly before we jumped on, because the news just came out yesterday, I think. And this was the first time I had a chance to look at it. And it was opaque, to say the least. They have a secondary market side of their site, but what was trading seemed very limited. So I have no idea whether there's any expectation. And it didn't really say clearly when you go to buy this what the expectations of the payout were. So I would urge them to add a whole lot more. But there is a prospectus there. There's all sorts of fun docs. Maybe if I had actually read those, it would explain things more clearly.
By the way, speaking of this, like raising money and all this stuff and real estate and everything, the Airbnb we stayed in last week in Fort Lauderdale, the building next door was 10x Fort Lauderdale. So it was one of the buildings that Grant Cardone bought right on the river.
By the way, I'm realizing right now as I'm going, like, I didn't have the time to look into this because I've been super busy this week. It'd be really nice to have a researcher. Imagine now I'm getting the appeal. Now I'm getting the appeal of being like, hey, this is a topic. Can you just go figure out how this works and explain it to me? Because I don't have the time to figure it out. I get it.
But wait, as we talked about before, though, does our insatiable curiosity and our whatever we're prone to kind of our eyes catch headlines, do you reduce that optionality of our curiosity by doing that, by having a researcher?
No, because I'm going to be more curious because I'm going to go, I can look at more stuff and just toss it to the person to figure out.
But, well, the presumption there, would that be that we actually talk about things succinctly on the show and actually do a deep dive instead of just babbling on the surface level?
Just babbling. No, we'll continue babbling. That's what we always do. With that,
you want to
Jason,
take us out here with the
yeah, let's do it. Let's do it. Let's get you back to the conference and cocktails. I know that's what you're dying to get back to it. So let's let you escape. Jason, I appreciate you calling in from Miami. And in fact, I want to applaud you bringing your mic with you. That was a nice touch. Puts a lot of pressure on me to bring my mic next week.
As you know, like the 2 bags, you're still shocked by. I traveled mic, camera, and even a corduroy onesie. I mean, you know, you got to have priorities in life.
And that hat. Well, folks, this has been yet another episode of the Pirates of Finance. Thank you for tuning in. Huge shout out to the Booty Crew for joining us live. Thank you if you're listening later. We appreciate the time. Don't forget to hit that like, subscribe, leave a review, a negative comment, whatever. We appreciate it. We appreciate your time. That's it. We're out. Enjoy your weekends.